Shall we go?
Yeah. You want to change our background or do you want it to remain the same?
White is fine. You want to change?
No, I'm asking.
Mine is fine. Are you asking for you or me?
Ashwin told me to change before.
Yeah, yours looks fine.
Okay.
Will you go? I'll present it and then we'll move. Visible?
Hi, good morning, everybody. Thank you all for joining in. Let's wait for a couple of more minutes for more participants to join. We'll start at around 10:05. I think we can start. Yeah, let's start. Okay. So this is a very, very important quote that we looked at before we started, Milestones2Wealth, because habits drive everything, right? So champions don't do extraordinary things; they do ordinary things, but they do them without thinking too fast for the other team to react. They follow the habits they've learned, right? This is the premise of Milestones2Wealth, right? This is why we had started Milestones2Wealth, because we understood that the way the difference in returns between you and somebody else comes only from a gap which is called a behavior gap. It has nothing to do with what they have bought, how they have bought, but it's majorly behavior, right? So we understood that, and that is why we said yes, we will do Milestones2Wealth, where we will work with different topics, make sure that from a behavior perspective, the investors that we work with, they are one of the best sets of investors, very smart in nature, that are able to capitalize on all opportunities presented to them. Right? Okay, we can go to the next slide. Right. So now, what are passive funds? Now, passive funds are schemes that aim to mirror the performance of a specific index. Now, why I have highlighted the green part is because you see they do not actively pick and choose investments, but instead replicate the holdings of a designated index. Right. Okay, so now I'll ask all of you a question. What has been the benchmark return from a CAGR perspective over the last 10 years? You can put your answer in the chat box. What has been the CAGR of Nifty 50 over the last 10 years? You can give a range also, there's no problem, but how much would that be? Okay, there's one answer on 15. Okay, okay, there's a 10. What else? Okay, there's a 12. 14. Okay, 12 to 13. Okay, 12 to 15, 10. All right. So this is from 2013, or 2014, right? So that is somewhere between 12 and 13%, right? But overall, anybody who's staying invested, from a long-term perspective of more than 10 years, usually earns between 9 and 12%. Right? It's not compulsory that they would earn very, very high return, but you can assume somewhere between 9 to 12% from a long-term perspective, because your time horizon is high. It's about 10 years. And uh, active funds, for that matter, are supposed to give you much more than that, because they are picking and choosing the best and making sure that they buy more of it, or they buy less of something that is extremely risky. By virtue of that, aim to give you at least 2.5% higher than what a passive fund would do. But what has been happening? You can go to the next slide. Okay, so if we look at the passive industry has had a huge growth in terms of AUM, and in terms of flows that are coming into the system, right? So if you see just in terms of ETFs, right? Today, government ETFs own a majority share. Then comes ex-government, which is a very, very small portion, right? And then comes your index funds. Right. So by virtue itself, what is happening in the passive side is majorly coming only from the government side, which is majorly your Bharat 22, your bond, your CPSE, and then whatever is ex-government, which is having a good share, is your broad-based index, which is your Nifty 50, your PSU Bank, again, which is government, your Bank Nifty. And so a lot of flows is only getting cornered here, and the industry has seen tremendous growth. Right, so let's split and see in terms of AUM just for ETFs. Who are these investors? You can go to the next slide. Right, so we see here equity is a major chunk of ETFs. 8.5 lakh odd crores. Out of that, 7 lakh crore is completely ETFs, which means out of this, out of 60 lakh crores, right, which is the total mutual fund AUM, half of that is equity, right? Around 30, 33, 34 is somewhere around equity. So half of that. So out of that, 7 is from ETFs, and that is equity in nature. Right, so it's still a very small, very, very small part. but it has tremendous scope for growth, and it has been growing very, very sharply. Right, just in terms of flows, just in terms of area. Forget the returns for some time. Right, we'll get to the returns part later. Right, but just in general, right, we've seen how things have taken place in the West, where it's more passive, and why it is more passive is because you have a lot of product innovation on that side. Right, and for a developed nation, which is continuously getting capital flows, passive works. But does it work in a situation like India, where we are developing in nature, where flows for us, we are now only starting to see very high domestic flows. Our SIP numbers only now have started to hit all-time highs. But for a developed country like US, it's a completely different thing. So that comparison should not be made. Yeah, you can see and learn from them, but that comparison should not be made because we are still small, we are still developing, we are still nascent. A lot of scope for opportunity, lot of scope for growth. Right, now, if you see 17% of total MF flows comes from passive. Right, so passive folio count, which is the number of investors that are there, itself has increased by 45% from 2.41 crores to 2.51 crores. Right. So there is proof that yes, it is a lot of money going in it, and there's a good amount of support that comes. So before I go to the next one, why do you think that investors are going more passive? That's another question to you, which you can answer in the chat box. Why do you think they are going more passive? Okay, there's a comment to. Okay. Okay, expense ratio to save on commission, less expense ratio, moderate return. Over long-term fund manager risk is more. Uh, it's tough to know the fund manager's capability. Solid reasons: performance, consistency over long-term, expense ratio, fund manager risk. All of this is so. There was a study that Motilal did, and this is Motilal Oswal's study where they roped in 2,000 investors and they asked them, why would you sort of invest in passive? Uh, there's one very good comment here. More influencers are promoting it. See, I didn't put that here because if you see it, the next generation usually they are doing this Gen Zs. They are going more and more passive because yes, you're right. They read blogs, so they are more blog investors. They are more blog readers. So passive is definitely a push there. And the previous generation that usually spends time on social media, and whatever marketing comes there in terms of passive investing, that's how they found out that yes, they should be doing that in the first place. Right, it has nothing to do with somebody coming and suggesting you, why don't you do this, why don't you do that? But Gen Z is predominantly blogs, and the previous generations to that has been more social media oriented. Right, and that is an actual study by Mutala, so I've taken it from there on. Right, okay, so why do people invest in passive funds? 57% said low cost. It's simple. There was somebody that said easy to choose from. Yes, but what I want you to see is that you get only market returns. Now, why do you think I highlighted only market returns? Say this 9 to 10, 12%, somewhere between 10 and 11% is what you're able to make. Very, very simply put, over a long period of time, yes, you are better off. But what is the risk that you are running with a market return? Any risks that you can see if you're just running a market return sort of a investment strategy? Markets can be wrong. Okay. Any other risk that you see? Where can markets be wrong? There's a clear, uh, very recent examples that have taken place in terms of how they can be wrong. And valuations can be too high, and we might have to blindly invest in SIP mode. All right. Many active funds are not beating the index. This I have proof for in the coming slides. Right, where the assumption is that they don't beat. No, there's a very handsome set of funds that do beat, which deserve your attention, because we are in a day and age where information is becoming more and more easily accessible, which means that our market is becoming more informationally efficient. Right, so anything, everything is sort of known, and that's why most of it is already priced into the market. Right, so somebody who's able to beat that by getting position sizing right definitely deserves your attention. Right, but I would go to this point of valuations can be too high because the methodology of a new stock coming into the benchmark is that it should be trading for these many number of months or years, and the market cap should be this much. So naturally, when it comes into the index, it has already performed very well, right, over that entire period for when it is being judged. So when it comes into the benchmark where most of your SIP starts going, because we are all consistent investors, right? So free float, right? That's the whole point. Right, so by virtue, when you are investing in an index and when a new stock comes in and replaces another stock, it is on the point of expensive valuation, right? So it goes hand in hand, right? That's why you see that you're only able to get market return, not market beating return, right? But for somebody in this, and as a saver, right, where you don't want to take up as per your low cost, right? When you want to go from a low cost approach, this is the best approach for you. But bear in mind that it is backward looking in nature, it's not forward looking. And what an active fund manager would do is that always it's going to be more from a forward looking point of view, not from a backward looking point of view. Something that has already performed comes into the index, and we are buying it at a higher valuation, which in turn does not lead to high returns. It leads to market return. It leads to some return, which is somewhere between 9 and 12%. Right, so bear that in mind always with passive funds. Right, Vinu, we can go to the next slide. Right, so the whole point of active investing is to generate alpha. Yes, it has higher fees, but we'll get to the calculation of higher fees because our return expectations are higher, right, when we choose active investing, where you have seen in the past that yes, there is a good amount of alpha that gets generated over the market return, right, where management style is more hands-on. You look at for passive, it's a more hands-off. It's more like set it and forget it. But what you have to forget is you continuously putting in that money. Yeah, that is a forget. That is on auto pay. The only thing is that you always have to track what's happening to the benchmark and what are the constituents that are getting added and deleted, because that is where your actual growth is going to come from. Same as what we would do when we are looking to invest with active fund managers, to see their behavior as to how they are adding more or deleting more. So definitely that's a big point for research, right? Skill requirement requires high research expertise, and then for passive is minimal, but that minimal has to be in this direction, right? See, it's more popular in India because India is a growing market, right? And in a growing market, the scope of more innovation on passive is definitely there, and growth will definitely come from there in terms of. So if you see what is happening to Nifty index, you just go. It's phenomenal. You just go to niftyindices.com, and when you hit indices, you'll get a bunch of options, broad sector theme, and there are so many indexes that have come up, and you're seeing more and more NFOs that are coming in. That's why you've seen a very big jump in terms of new folios that are coming in into passive, and now it constitutes to a huge percentage also in terms of AUM. right? So you'll get a lot of innovation from that side, but we will always be there for you, for for us to take advantage of passive investing, right? So bear in mind, this higher fees comes with higher return. So we'll get to that point of calculation also. So we did a simple calculation, right? So if you see, mostly you would see expense ratio somewhere between 1.5, average, right, would be 1.5%. And for that, our passive fund would be 0.5%. See, the brokerage involved here is 20. So for every time you invest, via Grow or Zerodha, you end up paying 20 rupees. It grows 20 rupees, right? And time horizon is obviously 10 years. So let's take from a long-term perspective. Now, most important thing here is the rate of return expectation. That's why I said somewhere between 9 to 12%. In history, it has done only 10 to 11% in history over a long period of time. Market, right? When you look at passive, so we have taken a 10% sort of an assumption when it comes to passive fund returns, and we've taken +2 because it is normal, right? When your expectation should be that they should generate some alpha between 2 to 3% over a long period of time. That's why you're paying them a high sort of expense ratio. But in relation to uh, even a high expense ratio, sort of, it's not high, I would say it's moderate. Even in that sort of a scenario, you're still making more returns than what you are from a passive perspective, right? Because there is this moderate return sort of a calculation that goes on, because market, like is backward looking. So 10% odd, if you take 12% odd, then yes, they have beaten, but you have to give them that +1.5%, +2% sort of addition in terms of active fund manager performance, right? So now let's prove whether they have been able to outperform, whether this math actually works or no. So let's go ahead and prove that. Are they going and beating? If you see, just from a large cap perspective, right, the number of schemes that have outperformed in 2024 has been 70%. So 70%, so 21 out of the 30 schemes have outperformed the benchmark, right? You know that benchmark is Nifty 50, right? Let's take a broader index. Let's take somewhere between, let's take a flexi, which would have some almost like a BSE 500 or NSE 500 sort of a benchmark approach, which is broader markets, right? Out of the 38, 23 schemes have outperformed this year alone, right? So which is 61%. So you are seeing visible proof that no, active investing works. Active investing is continuously working. But the risk that you run in terms of active investing is that some fund managers, some funds might not perform well, given the investment philosophy, given the style of that particular fund, and hence, like somebody commented that risk of, and there were many people that fund manager risk, right? That's the risk that you're sort of run. But with Milestones to Wealth, it's completely research oriented. We back fund managers that are only experienced, have gone through multiple cycles, and there's a team that does. So it's not one person making the decision. It's a team that decides on based on earnings quality, based on the fundamental quality of the particular fund, and only then it comes to you. Otherwise, it does not come to you, right? So proper research happens. So we are in that point where our schemes are in that outperformance category. But overall, right, from an industry perspective, you're seeing very, very healthy numbers. Now you look at where the number is not healthy. So comment on where the number you feel is not healthy, where there is very, very high risk. Okay, no comment. Fine. Let's go to a longer term to prove that yes, is there outperformance that is actually happening in active. So if you see on the left, right, you've had very good outperformance. This is older data, right, from 95 all the way till 17, right? So we've had 1, 2, 3, 4 years after 2005, where you've seen negative return coming in for active funds. Right? Though the industry has gone up, more funds have come in. That is a very, very positive sign. In those scenarios as well, we have seen that active fund managers have outperformed benchmark. Right? So it makes sense. So who does passive investing actually work for them? Right. So if you see from a 2018 perspective, right, we have till 2017, and then and all of this is public data. So if you see from 2018, 18, 19, and 20 were bad years. Why? Because there was a change in regulation. Right. 18, if you see, 89% of large cap funds were underperforming the Nifty 100. Right. 32% underperforming Nifty mid cap 150, and you see the number today, it is almost the 60% is only out. So 40% is that particular number. Small cap is even worse. 60% is what is underperforming, right, this particular year. But in history, we have seen that over long periods of time that yes, active does better. So who is passive actually meant for? Right. Now, I'll hand over the presentation to Vinu. Vinu, you can take over.
Thank you, Harshil. So far we saw a lot of data. So we dived into how passive investing versus active has worked in terms of performance, AUM, all of those. Now let's just look at a few more points on how investors are thinking about passive. So if you look at India as an economy, fastest growing economies globally. And when we compare them to even developed economies like US, so India's GDP growth stands somewhere between 5 to 7, 8%, whereas most developed economies are in the lower single digits. So when you compare India as an economy or India's passive fund industry to something like US, where 50% of the money in the mutual fund industry in the US is in passive funds. And you compare that to India, where only 17%. So we'll have to look at why this gap is there. So 50% to 17% is a large gap. One primary reason is going to be that passive funds in India are in the nascent stages. It is a recent phenomenon that where we're seeing passive funds being released into the industry. So we've seen a lot of NFOs from passive funds come out in the last 1-2 years. Majority of them have come 2 years. But beyond the fact that they are recent, the reasons go a little deeper into how generally Indian markets work and how Indian investors think. In the previous slides, we saw a lot of points about a lot of scenarios where active funds have actually outperformed passive funds. But if we were to look at that a little differently, if we were to break it down into just two parts, taking passive investments versus market and taking passive versus active in a flat market. So we'll cover that in the third or the fourth point. But in the next two slides, we're going to mainly look at how Indian investors think in terms of passive investing and what could be the potential for passive investments from here on. So let's start with the first point of why active funds have remained popular in India, which is huge growth opportunity. So India as an economy, like I mentioned, is a very fast growing nation. So this creates a constant stream of opportunities for active fund managers to generate better returns. So this is what we call as alpha. So if we take sectors like financial services or technology, automobile, these are all sectors that are constantly evolving. So an active fund manager can actively shift investments to capitalize on such high growing sectors, something that passive funds cannot do at this time. So it's the dynamic nature of India's economy that is making active investing more appealing. Looking at the second point of high volatility. So Indian markets, when you again compare it to developed markets like the US, are much more volatile. So this volatility is often seen as an opportunity by active investors, but in passive funds, it simply just reflects market volatility, nothing more than that. So for a risk-averse investor whose idea is to mirror the market, he feels he's taking more risk by taking on the volatility, but he's taking on this risk for no additional return. So investors start thinking that if I'm taking the risk of same volatility in my passive funds, why not go for active strategies, which could potentially at least give me better returns? So this is naturally how a rational investor would think, where they believe good fund managers can help them beat the market. So having the same volatility in passive and active funds in India is again pushing investors more to active because that can give them an extra push in their returns. And moving to the third point on mid and small caps. So we've seen extreme optimism towards mid and small caps, particularly in the last 4 years after COVID. So Indian investors simply love mid and small caps. And this is naturally because of their high growth potential. So there's a narrative that these companies can grow very fast. However, except for the last few years, if you look at passive funds tracking the small and mid cap indices, they don't usually capture the full potential of these stocks. Whereas active fund managers in the mid and small cap space have been able to deliver slightly better alpha in this space, where they're able to outperform active funds. Sorry, they're able to outperform passive funds and make it more attractive for investors. So this is where we'll have to look at how passive funds do in two different kinds of market. One is in a bull market and one is in a flat market. So usually if you see a bull market where we're seeing a lot of sectors coming up, a lot of investors flocking into the market, this is usually a period where we see active funds outperform. There's plenty of proof to show that in bull markets, significantly better, not slightly, significantly better than passive funds. Where passive and active become moderate or they start becoming a little equal is in either bad markets or in flatter markets. So these are periods where a good fund manager in a flat market, a good fund manager will be able to protect their investors from too much downswings. Whereas if you take the average mutual fund industry of good fund managers and average fund managers, they tend to more or less just diverge. So there's a clear case that when markets are doing extremely well, we will be seeing active funds do better. And in flatter markets, we usually see passive funds and active funds do as well as each other. And the fourth point is action bias. So let me just tell you what action bias first means. So it is when an investor feels the need to actively tweak their portfolios regularly. So this tweaking need not necessarily be any action that is required in the portfolio. But the investor generally feels that tweaking their portfolio regularly could just lead to better performance. We've seen this happen more in the recent few years because it's just become easy for us to make transactions on our apps. If you take apps like Zerodha or Grow, it's just a few clicks away to make some changes in the portfolio. So because of this action bias, people just naturally feel having some action to take in the portfolio means better returns. Whereas passive investing is a buy and hold strategy. So this can feel like a very hands-off approach for such investors. So some investors want to feel a little more involved and a little more proactive, which just aligns with active investing. This has also kept a lot of investors away from active investing in India. If you look at just a few more points of why active investment could actually help investors compared to passive in the next few years is one big point is going to be inflation in India. So if you take inflation in India, we stand at somewhere around 5-6% if you look at normal inflation. But if you look at particular areas like education or healthcare, inflation is much higher. We'll be at somewhere around 10%. So this is as much as what a market return could offer us. So since inflation is so high, Indian investors have the need to grow their wealth at a much faster pace. So this is where active investing comes into the picture, where it aims to generate something higher than market return. So investors who are coming to the market with this idea in mind of beating inflation to a significant level, for them, passive investments may seem too conservative. And the next point of young investors. So India is a very young country. So we're one of the youngest countries in the world. And naturally, young investors love to take risk. So they take risk with the idea of being able to generate high returns. So this generation does not shy away from investing in volatile markets or in sectors. They just are going for active investing because it promises outperformance. And the final reason of why passive investing is yet to pick up as well as the US in India is because of lack of awareness and education. Like one of the commenters pointed out in the past, there's a lot of influencers that are speaking about passive investing now over the last few years. But many investors are not fully informed about how passive funds work or their potential benefits. Whereas active funds, if you see, are generally just well marketed. They're backed by very good distribution networks, and they're just made much more accessible for Indian investors. So just to summarize this segment, so India is a fast-growing economy. We are in a very volatile economy, or we're in a very volatile market rather, and we have investors who have very unique mindsets where active investment has generally been made a preferred choice. So, however, as awareness grows, we might be seeing a trend of investors shifting more towards passive investments. But for now, India remains a stronghold for active funds. Now, I also wanted to touch upon uh, a strategy that could work. So we've been seeing about how we invest in active funds separately or passive strategies separately. I wanted to touch upon how we can mix both of these. So we debate between active and passive, but there's no reason for investors to choose one over the other, we feel. A balanced approach, combining the best of both strategies, can be a very straight or a smart way to make their investment. So let's just explore each of them one by one. So the first one is being tactically passive. So the idea behind this strategy is to focus on maintaining a passive fund strategy, but with some tactical insight. So instead of just blindly sticking to a buy and hold investment strategy, you actively monitor your passive portfolio and make incremental investments whenever the market presents you opportunities. For instance, during a market correction, you might increase your investments in passive funds to take advantage of the lower NAVs that may be available. So this is something that we have been doing on MTW. We've done in the past. We've done this through NASDAQ, which is an ETF, which is a passive strategy. We did this through a few nifty equal weight funds, which are also passive strategies. So we've always been advocates of maintaining a combination of passive plus active, where we should be taking passive approaches which seems to be of good quality and where it can add value to the investor. In other cases where active can actually do better than a passive fund, there's no need to go for passive. So we've played this through a few funds, and we've it's actually worked out in favor of the investor because they want a portfolio which has lower cost. So adding some passive investments to your portfolio naturally makes it a lower cost portfolio. So by being tactically passive, you enjoy the cost efficiency and simplicity that passive funds offer, while also having the flexibility to act whenever needed. So moving to the second one, which is selectively active. So this is just an inverse of what we saw earlier. In the earlier one, we saw maintaining a passive portfolio and adding and being a little more active whenever markets present opportunities. If you look at selectively active in this approach, you maintain a portfolio of active funds, but you avoid frequent changes unless it is absolutely necessary. So, for example, instead of constantly chasing the next best performing fund, you just focus on long-term goals and make adjustments only for specific reasons. Let's say the fund has become risky, or there is a significant change in the fund manager strategy, or if you approach any of your financial goals. So these are reasons for you to make a change in the portfolio. By just maintaining a portfolio of active funds with minimal actions itself will reduce your cost. It will reduce your need to make emotional decisions, and you'll just leave the job to some experienced active fund managers. This is also something that we've played out in our MTW platform successfully. So we did this through PSU funds and infrastructure funds. So both of these were segments which had very less weightages in the passive segment. If you take a Nifty 50 or Nifty 100 or Nifty 500, the exposure to was very minimal. So we decided, instead of just playing the passive route or just playing the active route, we thought we'll pick a specific sector which has the potential to do even better. So we ended up picking two active funds in both PSU and infrastructure. Most of you might know what has happened after that. It's more than doubled. In fact, PSU has gone 200%. Infra has also gone somewhere around 200% from the time that we picked. So playing selectively active in this case ensures that you're not over trading, but you're still staying aligned with the market opportunities. And the third one is going to be about multi-asset investing. So I'm just showing you something called an an asset allocation quilt. This is what I'm presenting to you. So this is a strategy where you combine active and passive investing with multiple assets. So we've generally seen equity as a primary asset when we speak about active or passive investments. Here, your portfolio includes a mix of equity, debt, gold, and international funds. So you can see passive investing, you can use passive investing as a stable asset class for your portfolio, and active investing where it can add some value to you. So if you look at this quill, there are years where assets which are not even equity in nature have done extremely well, are top performers. There are 4 years where gold has been the top performer. There is a year where debt has been a top performer. In 2016, we're seeing government securities being the top performer. In 2015, also we're seeing debt being the top performer. So on the converse side, we're also seeing gold or small caps being one of the worst performers in a few years. So this just goes to say that there are years where some assets do well, and there are years where some assets do extremely bad. So this diversification of multiple assets in your portfolio, it not only reduces your risk overall, but also ensures that your portfolio is well positioned to capture returns from different asset classes under different market conditions. So I'll quickly move on to what Milestones to Wealth is doing. So we started Milestones to Wealth around 2 years ago. So Milestones to Wealth was started with the intention of guiding investors to build a portfolio with professional guidance. The core idea here was to handhold investors and take them to at least 1 crore and beyond. And how we look at this is through two things. One is going to be through product selection, and second is going to be through behavior management. So I'm just showing you five traits that we consider as behavior. So when you take anybody's investment journey, we would consider product selection, or a mutual fund, or going for the right fund selection is only going to be 30% of their journey. The remaining 70%, the majority of it, is going to be on how they're going to manage their behavior. And we feel this is where a lot of investors fail to make or fail to succeed, because there is a very clear data that is available where investors who go for direct funds mean that they do their own research and pick direct funds. There's a data that says that direct fund investors don't stay invested for more than 1 year. So what this goes to say is they're not consistent. They don't have the stomach to stay invested, or they don't have another somebody to just hold them and tell them that what you're doing is right. Or so what we aim to do with M2W is to help you more in terms of behavior and partly in terms of selecting your products. So the first point is on doing more. So people sometimes hold cash in their hand, but they don't. They want to time the market exactly on its bottom. So we'll have to understand that this is not possible. So what is a good way to do this is, one, to just consistently run an SIP. On top of that, whenever you have some money in your hand, which is not meant for the next 3-4 years, you can consider pushing it into the portfolio. Second point is staying invested. This is what I had touched upon just a minute back, where the entire idea of investing is going to be to stay. While I did mention about how the economy is fast growing, how there are sectors that are changing, this is one point where an active fund can come into favor. With a passive strategy, there is a need to constantly look at what is evolving, and there is a need for us to take decisions on how we can move this and align ourselves to the growing context. With an active fund, this is just easily taken care by the fund manager. We don't have to do much. We just invest it. We just have to ensure that the fund manager is of good quality. The kind of stocks that they're picking is of good quality. That's simply what we'll have to do. Third one is to show and maintain patience. So I think this is something that could start being a problem in the next few years, because in India today, almost 50% of the investors who are in the market are new investors. What I mean by new is people who've come in after COVID. So almost 50% of the market are new investors. So they've not seen a bad market. In the last few years, we've only seen positive markets. We've not seen a bad market. So when the markets start becoming volatile, or when it starts becoming flat, that's when we need somebody on the side to show or to handhold and tell you that this is the right place. We are on track. You don't have to worry. So with Milestones2Wealth, we intend to offer you that handholding in terms of good place to invest. We try to differentiate this. Fourth one is understanding your potential. So let's take somebody that's earning, let's say somebody's earning 50,000 per month, but they're only investing 2,000 or 3,000 as SIPs because they want to test the waters. So this is a clear case where they are not investing to their full potential. So even if they invest 5,000 as an SIP on a 50K salary, for an entire year, they're only investing 1 month's salary. So you need to take a clear stock of how much you are investing as part of your actual earnings. You need to ensure that whatever you're saving and investing is actually a big portion of your savings, which can make some significant impact in your overall net worth in the longer term. And fifth point is to grow your potential. So this is not on us. This is going to be on you guys. So the entire idea of M2W is to help the investor take their mind off their portfolio. So there should be a case where you just leave your investments on the side to somebody that can manage the investments very well. You don't have to worry about it. You just have to keep contributing whatever money that you earn. But what you might start focusing on in that case is on your work. You may start looking at where you can improve or where you can progress in your career. So there's a very good saying that one of my colleagues says, equity can give you returns, but your biggest equity is actually yourself. If you as a person can compound faster, then your assets are naturally going to compound larger. So this is, so I touched upon this point in the last slide. So we may start seeing a boring market from here. We were in a very, very exciting market in the last 4 years. This could be a time where we start seeing some boring markets, and boring markets are actually the best time for somebody that is building a portfolio to stay invested in. So if you were to just look at any sort of a chart, would you prefer investing in a market that is like this, or would you prefer investing in a market like this? So when you're investing in a market that is flat, let's say you're investing at a 10 rupee average. In a flat market, you're able to invest at a 10 rupee flat average. In a rising market, what you're losing out on is time. There, you're going to be investing at a larger average. You're maybe investing at 12 or 13 or 14 rupee average. So people start panicking when markets start going down, but they don't think about the fact that their goals are actually not in the next few years. Their goals might be 10 or 15 years away. So for somebody whose goals are very, very long, or it's not anytime soon, they should actually be embracing bad markets. They should be enjoying bad markets. The only thing that they'll have to worry about or be careful about is investing in bad or rotten parts of the market. So if some parts of the market are expensive, you need to start avoiding those spaces. But when markets get boring, that's going to be the most exciting time for you as an investor. This is your opportunity to make lump sums, make SIPs, step up your SIPs, and keep contributing as much as possible, so that when the market starts performing, when the markets actually become exciting, you're able to reap the benefits. So to just summarize this slide, a market, when you're building your portfolio, you should actually hope for a boring market. When you fully build your portfolio, that is when you should be hoping for an exciting market. So you think of it this way. And this is a simple slide on compounding. So at the end of the day, all of us are in the markets to make money. And the reason we say there's a need to stay invested for the long term is because that's when your money snowballs. This effect is called compounding. This is a very simple slide that says how fast your money starts to grow the longer that you stay invested. So if you take this slide as an instance where this investor takes 7 years, or sorry, he takes 8 years to reach 1 crore. But if you look at every crore from there on, it is much quicker. His next crore, from 1 crore to 2 crore, he goes in half the span of 4 years. Then to 3 crores, he goes in 3 years. And as you see the progress going, for every crore, for somebody to when they're reaching 6 or 7 or 8 or 9, taking them a year to reach from there. So what this slide actually goes on to show is when you're making an investment for a very, very long term, in the initial years, the amount that you contribute towards the portfolio is going to be larger. The returns that you make from it is going that you would have contributed is going to be very small. But the returns that the markets would have given you is going to be the significant part of whatever returns that you've made. So the idea is going to be to identify good areas for investment. The idea is going to be to be very consistent with your investment, be disciplined, stay for the longer term. And 3 is going to be to just let it cruise. Don't worry too much about market volatility. So markets will be volatile. That's the nature of markets. This is not an FD investment. The reason we're able to make returns is because markets are volatile. If markets are not volatile, we'll not be able to invest cheap. We'll only be able to invest in a rising market. So embrace bad markets, identify good choices, and reap benefits when the market becomes exciting. So we'll move on to Q&A. We'll open up the Q&A box from here. So any questions about the presentation or about personal finance or investing in general, you can drop in your queries in the Q&A box below. Or there is a Q&A box separately, one of the 2 spots you can drop in your questions. Actually, you want to take this as a question on alpha?
So the see, okay, so there are 2 questions. Okay. What is the alpha we are looking for in an active investment? See, the point is for an active investment, there's no number to say that, it should be +2, +3, +4. It should just be that the construct of the fund is very solid. That's one. Second, the experience of the fund manager has always resulted in some alpha. Now, in cases when it has not resulted in outperformance, we need to understand why it has not resulted in outperformance rather than judging too soon to say, no, this is bad. Right? So we are always looking to have conversations with the team to understand why, this level of underperformance or why this alpha has been lower compared to the benchmark, and why this particular investment philosophy, has outperformed or underperformed. So we are always on the lookout to understand how that number is arrived at, not to say that 2 is good, 3 is good, 4 is good. Right? So Vinu was talking about PSU, right? So PSU had there was no alpha, right? It was negative for at least 3-4 years, so 18, 19, 20, 21. They were negative. So we are not looking on that angle for always wanting to outperform. We need to understand why it is not happening, and is there an opportunity for us to capitalize on for when things turn where the alpha becomes much more higher. That is why we are doing active. Okay. There's a question on how do you do passive for gold and silver. Then do you want to take that?
Sure. So that's when our strategy has to become active. So as I mentioned, if you have to summarize this entire presentation, the summary is that we should not be fully active. We cannot be fully passive. It has to be a combination. So that's a very short summary of how it should be. So if you were to look at gold and silver, we are very, very positive on this space. But if you have to take this into the portfolio, then that's when we have to become active. So if you're going to remain passive and just sticking to Nifty 50 and Nifty 500, then these are sort of investments that we tend to miss out on when other assets become attractive, or when certain parts of our portfolio is starting to become unattractive. That's when we have to become a little more active. However passive our strategy may be, there is some point in our journey where we will have to become a little active so that we can mitigate our risks in the portfolio. So the idea behind going passive or active, we wouldn't put it about returns at all. It is fully going to be about how you can manage your risk. If you're able to manage your, let's say the markets falls another 10% from here, but if you're able to protect your portfolio, let's say you fall only 5% by becoming a little active, maybe you paid that 1% extra expense ratio, but if you're able to fall lesser, you paid that 1%, but you've saved 4% on your returns. So that's the other way of looking at it. So if you're looking at passive and active beyond returns, we would say you can start looking at it as a risk management tool. So we are advocates of gold and silver at this point in time. This is something that we've actively been adding in our portfolios. That's that part of it. So gold and silver as ETFs are passive strategies, but adding it to the portfolio as an overall strategy becomes active. If that answers your question. And there's a question on what books you would recommend on
Yeah.
investments.
So before I get to that, right? So I'll just add to this point. See, the whole point of passive is not set and forget. The whole point of passive is that it tracks an underlying benchmark, right? So you always have to continuously actively manage it when it comes to. So always look at passive from a point of it is replicating a particular benchmark. It is just tracking price, right? So don't look at it from a set and forget. No, you will always have to actively manage your investing. You yourself will have to actively manage the passive side as well. So that's about it for that question. What is the book you recommend to read about investments? See, I think Mastering the Market Cycle by Howard Marks is pretty good. See, always don't shoot for the stars. Just read something that's very, very basic, because it's easy to understand. It helps, and if you always stick to one particular genre, then you're limiting yourself to that. You read any book that that will always add into your behavior trait. So just pair it with a very simple investment book.
If I were to give you two recommendations, one would be a simple one of Psychology of Money, which can manage your behavior. That is on behavior. If you're looking at on investing specifically, then a good book is going to be Masterclass with Super Investors. This, why I'm specifically saying is it is in context with Indian investing. So a lot of books that we generally look at online is going to be about US investors or European investors. This book, Superclass with Master Investors, is specifically about Indian investors. And in fact, Sham sir is one of the investors who they have covered in this presentation.
Don't get too obsessed with stock price or stock name. It's read the philosophy. They read what goes into staying invested for a long period of time, showing conviction. So that's what you should actually take off from that particular book as well. Right. Okay. So there is one question on will there be a change in the investment strategy based on the amount invested? If somebody is starting with the 10,000 SIP versus someone that of a 1 lakh, no, it's not amount based. It's goal based and it's risk profile based. It's not amount based. For somebody who's having a goal which is a short-term goal in nature, then asset allocation would change. So everything, so the entire asset allocation and the investment strategy would be based on your risk profile, number one, whether you're able to take risk or not, your appetite and your willingness to take risk, and second is on what goals are you actually investing for. So it'll be based on that. It's not based on the amount, and we never do this based on the amount. Never. I'll take the next one also. Does Sphere Neo only have passive ETFs for equity portion? How does it stand when it comes to Sphere? No, both have ETFs, and like we were talking about how we can tactically use baskets, right? I would always look at passive from a point of it is a basket for when you can invest in, when it is extremely cheap in nature, particularly. That's when you should actually be doing a big basket. So both have ETFs. It's more from a basket approach, tactical approach, more sector theme. You're not having a broad base sort of an approach. Right. And for Neo and Sphere, the allocation would be slightly different. Some would have more, some would have less. Okay. Vinu, I think you can take this one. How do you choose the SIP for an underlying mutual fund?
Yeah. So if the question is on how to choose an SIP or the underlying, okay. So
How do you choose? Yeah.
Not sure how to, if I understood the question correctly, but if you're asking about how much you should be doing as an SIP, I would suggest you look at it in percentage terms of your savings. Generally, a good percentage that you can look at just to start off can be at least 25% of your income. But otherwise, you have to look at how much you're able to save. So if you're asking how much as part of my savings I should be putting towards SIP, I would say at least 80%. If you're able to save, for example, 10,000 per month, I would say do at least 8,000 as SIP. Remaining, you can either keep in the bank account for other expenses, or you can save it for lump sum opportunities. But when your cash flow is there, maximize your SIP, because you're not going to. Yes, we will be creating some impact by making lump sum investments, but with SIPs, if we are consistent, our involvement of emotions in making these investments are reduced significantly. So that is one point. And how to pick underlying mutual funds, this is not an easy answer. So this is going to be on assessing how the quality of companies in a mutual fund are, how well the fund manager is running the portfolio, what he intends to do to the portfolio in the future. So these are things that require much more understanding than just a simple answer. But this again, so this is where if when it becomes very difficult for an investor to choose a fund is when they can start leaning a little towards passive, or they can alternatively look for some professional guidance.
See, the thing is, and I'll add to that, most investors, chase performance. And so I had done this I had shown this data point, a couple of weeks back, and it's all public, so you can go, you can look at mutual fund presentations, right, where they have highlighted saying that what happens when you chase performance. Like, there was that quilt, right? Can you just go to that part? See, it's not as simple as looking at what how the mutual fund is doing in terms of performance and just go with the one that is doing very well, right? So if you see, for example, 14 to 17 small caps did very well. After that, it has not done. So somebody investing on 1st Jan and saying, I don't have so much money, but I will go with the best performer that's there, and looks back and takes a decision based on the past. You're seeing whatever ratios, right? You learn from beta, alpha, Jensen's alpha, all those ratios, right, that come to you, right? So you see all that, it's all looking extremely good, and you start investing on 1st January 2018 in a small cap fund. After that, 2 years you don't make money, you lost money. 3rd year you still don't make money because the fall has been so deep that you have not recovered completely. Then in 21 you recover, but you stayed invested. Since you're all long-term investors, you stayed invested for a good 4-5 years where your CAGR is sub single digit. Right? Then again in 22 you don't have a great year where again our job is when we are choosing a particular fund to invest in, we want compounding to work for you, not against you. Right? So that's why when we are looking to do mutual fund research, we only see from a forward perspective of how the fund is constructed, in what is the earnings potential of the companies that they are investing in, because we have an in-house research team that assists us with that, and what is the quality, right? So we have certain internal metrics to say, yeah, this is a good quality fund. In this particular cycle, we can take advantage of these particular funds, and hence we go with that. And all the ratios would show against. If you check Value Research, the best performing fund for us has been a no star rated fund when we started investing, right? So we understand that what is shown outside is more backward looking, but what we want to do is more forward looking. And hence you have to stay out of the crowd. You have to stay away from the crowd. And that is what you get from us. If when you go ahead and partner with us, you don't get what is consensus. You get something that is outside of that entire box. Okay.
There's a question on Nifty going on. I'll take this. You have a very interesting question next on fund manager. So on Nifty going down, yes, this is a great opportunity. So every time the market goes down, it's a great opportunity. But looking at just Nifty is going to be a very one-sided way of looking at opportunities, because opportunities are not only Nifty dependent. If you take Nifty today, they are banking heavy. They're almost 30-35% banks. So if banks go down, Nifty goes down. If certain heavy weighted companies like Reliance go down, Nifty goes down. But that does not necessarily mean opportunities are available everywhere. So you have to look at specific areas that you are interested in investing in, and you will have to track those independently. Because if you take the recent fall, Nifty has gone down. Yes, it has gone down. But there's a segment like consumer which has gone down even more. And then there's a segment like banking which has gone down a little lesser than Nifty. But if you ask which has a better opportunity here, we say both. Because it is not dependent on Nifty. It is independent of banking or consumer. So the opportunity, not broadly on Nifty. But if you're asking if this is a good time to make an investment, this is actually a great time to make an investment.
Yes. See, and if you're not on the platform, if you're not, subscribed to us, then you will not get those details. So that's, I would say that just send us a hi. You'll have a point of contact that gets in touch with you. We call them growth accelerators, and they would immediately get you on board, start up with your start up the account opening process, so that you can visibly see and take advantage of growth. Right? So and you will constantly keep getting messages from our side. I think recent message also was more from a point of, hey, it's Christmas sale, why? And this is what you're able to get at discounts, right? That's what that's what we refer to the falls as. And just get on the platform. If you're not on the platform, you will get a lot of interesting stuff. Okay, next one is a very, very interesting question. How does a fund manager's departure typically affect the performance of an actively managed fund, especially in Indian markets where the fund manager expertise is often a key? Fund manager expertise is key everywhere, right? Even India, domestic, everywhere. But the whole point there is that the obsession over beating the index is higher because the index does very well. Right? Flows that come there are very, very high. Right? Now, are we in for long haul? Is it a significant factor? Yes, it is a significant factor because firsthand we have faced that experience, where a change in fund manager has impacted the ability of the fund to perform. Now, see, for example, let's say if for example, right, me and Vinu, right? So if we are, that's why and I'll tell you how they've de-risked this, the industry, right? So, for example, me and Vinu are doing, we are fund managers, we are investing for people, we are running fund houses. His style is completely different. He's operating in a particular segment of the market. I'm operating in a particular segment of the market. Let's say I'm flexi cap, he's multi cap, right? And there are certain rules that are set to say that a multi cap should have this much in large cap, this much in small cap, this much in mid cap. Flexi should have this much, and this much, right? Now I'm running a philosophy, he's running the philosophy. Both of us are doing our own jobs. Something unforeseen takes place. I get a better opportunity, or I have to quit. So I say no, I'm leaving, and I'm going to pursue my own thing. And the AMC says that, okay, Vinu has done very well with this multi-cap fund. It's almost a similar category. So why doesn't Vinu take up this thing? So Vinu takes up that entire thing. Now, problem is that I've been running it from a particular strategy standpoint. I've been running it with a philosophy based on my investing style. And when he comes, he will obviously try to layer what has been successful for him into the particular fund, which takes time, right? So which takes time. It takes about 2-3 quarters. We've seen it firsthand affect long-term performance. And we always, we are very cautious when it comes to, we've seen it plus also, huh? We've seen it where a change in fund manager has actually benefited. So we've seen both the cases. So both the cases are very much possible, right? But it's just that how the previous fund manager was working, and when somebody comes in new, you have to actively track, you have to actively discuss to see whether it, are they in line, is it in line with what the philosophy of the AMC is, and second, with how the fund is being run. Can the damage be lesser or can the gain be more? So for example, we've had in our universe itself, we have had 3 fund manager changes. 4, 3 has worked out, 1 has not. Right? We are always on the lookout. Right? There's more work that starts going into that particular part. But in a long-term perspective, this particular thing matters. And how they've de-risked this is that the research team is the same. So there's not fund manager saying, I want to do this. No, it's more from a perspective of, there is a universe that the research team works on. Second, it goes to the investment committee for approval. So it's already work that is being done by the entire team. Right. So the fund manager is basically cherry picking based on his particular style of how much to do and how much to buy of that particular thing. Right. So things have changed. There's a lot of de-risking that has happened in the industry, where it's more from the DNA of the AMC rather than the DNA of the fund manager. Right. So it's all set now. So we've not seen as much of issues as what we used to see in the past. Okay, there's a question on last few years. SIP has done in the index funds or small and mid caps have outperformed even active funds, but besides both mid and small index SIP returns are in the first quartile. Vinu, do you want to take that?
Yeah, sure. So okay, so how we see this is we see this to be more liquidity driven. So if you take the mid and the small cap space, you can't directly compare it to how the large cap space operates. If you take the large cap space, one, there's a lot of information that is available there. Two, it has become a large cap because it is a company of quality. They have done certain things right, which is why they are a large cap today. If you take the mid and small cap, we can't broadly tell that every company is a good company. In fact, we'll have to tell the opposite. There are a very, very few companies, or it's a very specific subset of companies that are of good quality. So if you take this as the mid and small cap universe, your actual good companies shrinks down to this. So your index forms just this. It does not have this. So when a lot of money keeps coming into this small segment of stocks, naturally performance is coming from fundamental performance, that is coming from liquidity. What the recent past is that mid and small cap indices have been moving more based on liquidity than fundamentals. So this is something that will normalize. We a lot of either price will have valuation, price is coming down, or company performance will have to match up to where the prices are. So it'll either be a time correction or a price correction, but fundamentals and prices can't remain deviated too much for a very long time. So that will have to happen. That divergence will have to happen.
Yeah. Okay. To quote Warren Buffett, passively managed ETF always beats any fund manager in the long run. What is your opinion? Warren Buffett is he's right in a sense, because US is a developed nation. You're seeing more capital flows there. You're seeing money just pouring there left, right, and center. When we review 401k, we see money going to the same top 10 stocks. When we review UK pension plans, the money that goes again is into the same top 10. So money comes into the US as well from there. So US is the largest market, one. And today, I think I just saw some data. Let me just validate that. So it was data to say that the largest part of global markets is the US. So a lot of money keeps going into the US, and hence it's more efficient, right? And that's why naturally for them passives would do well, because things there's active management does not really sort of matter when things are very very good for you on that front, because every the information is very good, you're getting money continuously. So uh, so when you want to go to the from one thing to the other thing, it's simple, it's not hard work. So even usually in those cases it works very well. Thing is, in terms of uh, India, right? India is still developing. You're seeing a lot of products, you're seeing a lot of stuff. Uh, you will see somewhere down the line that, yeah, if flows are very, very strong, if, as things start getting much better in terms of us being an informationally efficient market, you will see passive do well. Okay, good insights. Thank you so much, sir. Thank you. Uh, okay, I already contacted. I thought my KYC is pending. Do you want to take that?
I think, is there any other question? I think we're good, right? For the KYC. So we'll just check, based on your email, we'll just get in touch with you. We'll see where this stands. But thank you for registering with us. I'm sure it'll be a great journey to give our every. We've mentioned our email ID, our website, and our phone number. Feel free to get in touch with us if you have any queries regarding your portfolios. If you have queries regarding how much should I invest, how should I invest, where should I invest. So all of these are questions that we look to address through Milestones2Wealth. It's an initiative where we want to take a lot of investors to a 1 crore milestone and beyond. So this is something that we've intentionally set to work with smaller investors. We want to work with a lot more investors than what we have now. I'm just happy that all of you joined us for this webinar today. We hope we answered a lot of your questions. Other questions, of course, we're happy to take them online. Our office is open. We're based out of Chennai. We'd be very happy to meet you anytime that you guys walk in.
Somebody has, I think we're having a hand raise. I don't know if you can give them unmute or mic access, something like that.
Mic access seems
Can we
to be
do that?
blocked.
Okay, I've given you mic access, so you can interact with us. Okay, I don't think
I've made
anything.
note of the name, so we'll see what the email ID link to that is. We'll get in touch.
Sure, done. Thank you all. Thank you so much
Yeah.
for your time. Thank you.
Great. Thank you very much, everybody.